Welcome to the ProTicker Deep Dive. Today, we're digging into something really significant, that recent quarter-point rate cut from the Federal Reserve. The new target range is 4.00% to 4.25%.
Yep, just 25 basis points. Sounds pretty standard, right?
Exactly. But when you look closer, the story behind that cut, it's telling us something much bigger about what might be coming for the economy and, for your portfolio.
It really is. It signals a huge shift in what the Fed's focused on. And that creates this central tension we really need to get our heads around.
So what's the core question everyone's grappling with now?
It boils down to this. Is this the start of a fast, major easing cycle? The kind that could maybe pump life back into the markets, help out housing? Or is the Fed kind of stumbling here? Are they walking into an inflation trap because they're trying to rescue a job market that's clearly starting to wobble? That's the risk.
Okay, let's unpack that pivot then, because like you said, this wasn't just tweaking the numbers. It feels like a fundamental change in their thinking.
Absolutely. There are three big takeaways that show us, yeah, the Fed's changed its game plan.
What's the first one?
First, they're moving earlier than almost anyone really expected just a few months back.
All right.
Cutting now, hinting at another one maybe in October.
They're getting ahead of it.
Exactly. They're front-loading the easing. It's like preemptive damage control. They want to get that stimulus into the system now to cushion the job market before things get worse later this year.
And the fact they feel the need to front load, that points directly to the second takeaway, doesn't it? Which is honestly a bit humbling for them.
It really is. It's basically an admission. That strong job market they kept talking about, it wasn't nearly as strong as they thought.
How much weaker are we talking?
Well, the data got revised big time. We're talking nearly 1 million jobs just erased from the books. Poof. Gone from the past year's data.
Wait, 1 million? That's huge. That's not a minor adjustment.
No, it's massive. And you see unemployment ticking up now, 4.3%. Job openings are falling too. It completely changes the picture.
So it's like they were driving based on a faulty map, and now they realize they're heading somewhere else entirely.
That's a good way to put it. It suggests maybe they tightened policy, raised rates for too long, right into an economy that was already slowing down underneath the surface. So now they're acknowledging, okay, the jobs risk is the big worry right now, maybe more than inflation.
Which brings us straight to that third takeaway. And this one feels pretty controversial. Easing rates when inflation is still kind of sticky.
Yeah, that's the gamble. They're essentially choosing to accept more inflation risk.
Sacrificing some credibility on inflation, fighting to protect jobs.
It looks that way. For 2 years, the message was crystal clear. Price stability first. Now. It seems they're willing to tolerate inflation staying above target if it means stopping unemployment from rising too much further. That's a major philosophical shift. It tells you just how concerned they are about jobs right now.
Okay, so this pivot makes a bit more sense when you consider the really weird economic environment they're dealing with. This isn't your standard slowdown, is it?
Not at all. That period where the economy just seemed incredibly resilient, it feels like that's running out of steam.
But Q2 GDP was revised up, right? To 3.3%. That sounds pretty good.
It does, on the surface.
Yeah.
But you scratch beneath that, it's a bit deceptive. The momentum's fading. Things like government spending were lower, imports are rising. It suggests maybe domestic demand isn't quite as robust. The headline looks good, but the engine might be sputtering.
And that sputtering is clearest in the job market, which seems to be unraveling. You mentioned 4.3% unemployment. Historically, that's not terrible. So why the sudden concern from the Fed?
It's about the direction, the trend. Unemployment was stuck below 4% for ages. Stable. Yeah. The moment it starts clearly trending up like this, especially after that long run, that's a classic red flag. It signals the cycle might be turning.
And coupled with those huge job revisions.
Right. It means they might have been tightening policy, raising rates when the economy was weaker than they realized. Like hitting the brakes when you thought you were speeding, but actually you were already slowing down.
Which helps explain why inflation is still such a headache, right?
Yeah.
They're cutting rates, but prices aren't fully cooperating. Where's the stickiness coming from?
It's kind of a two-pronged problem. You've got goods inflation that actually ticked up a bit. Usually, in a slowdown, goods prices fall.
Why that?
Partly lingering supply chain stuff, but also, tariffs have an impact. They push up the cost of imports.
So geopolitics is making their job harder.
Definitely. And then you have the big one, services, housing, healthcare, wages. Inflation there is just notoriously sticky. Rent costs, medical bills. Those things take a long, long time to come down, even if the broader economy cools off.
Okay, so let's put it together. We've got slowing growth, jobs looking shakier, and inflation that just won't quit. It sounds a bit like stagflation light.
That's a pretty good description, yeah. Stagflation light. It means the Fed's caught in a really tough spot. They're trying to fight off recession risks and persistent inflation at the same time.
And the tools for one problem often make the other worse.
Exactly. Cutting rates helps growth but could fuel inflation. Raising rates fights inflation but could kill jobs. It's a real tightrope walk. That's why this pivot is so significant and, frankly, so risky.
Now let's shift to how the markets took all this news, because the reaction was, well, a bit schizophrenic, wasn't it? Especially in the bond market.
Oh, completely. Total dissonance. Initially, the reaction was very dovish, expecting lower rates. The 2-year Treasury yield, which really tracks near-term Fed moves, dropped almost 10 basis points right away.
So short-term relief, yay, cheaper money soon.
Pretty much. But then the 10-year yield did the exact opposite.
It went up.
Yeah, it was striking. By the end of the trading day, the 10-year yield, which reflects longer-term views on growth and, critically, inflation, was actually higher.
Wow. Okay, so the market is sending two completely different signals at the same time. How do you even interpret that?
It's the market basically saying, okay, thanks for the rate cut, now we see the economy's weakening. But simultaneously, we're worried you're cutting too soon, and maybe you'll lose control of inflation down the road.
So short yields down, long yields up. That's the market signaling skepticism about the Fed's long-term inflation control.
That's exactly it. It's a classic warning shot. It means traders are saying, we believe you need to cut because things are slowing, but we're not convinced you can do it without letting the inflation genie out of the bottle again. So we need to be paid more to hold long-term bonds.
And that nervousness wasn't just in bonds, right? The stock market was choppy too.
Yeah, definitely saw that ripple through. Growth stocks think big tech. Momentum names, they like the idea of lower rates. Cheaper capital helps their valuations.
Makes sense.
But then you look at cyclicals. Companies tied to the economic cycle, like manufacturers and financials, like banks. They were much more cautious.
Worried about what weaker jobs mean for earnings and loan defaults.
Precisely. They aren't buying the smooth sailing ahead story just yet. They see the potential downside of a slowing economy.
And adding to all this uncertainty is the fact that the Fed policymakers themselves don't seem to be entirely on the same page. Their own projections showed some disagreement.
Oh, for sure. It wasn't a united front. Most of the members saw rates kind of drifting down gradually towards 3% over the next couple of years, the sort of measured, controlled descent.
But there was an outlier.
Yeah, one pretty notable projection showed a much, much steeper cutting path. We're talking 2 back-to-back 50 basis point cuts before the end of this year. So another 100 basis points of cuts, quite aggressive.
Whoa, so a real split internally. How does the market react to that kind of division?
It makes markets nervous. They don't just price the middle view. They start pricing in the volatility that comes from that disagreement. They start wondering, who's actually driving the bus here? Which policy view is going to win out?
So while the Fed figures out its internal debate, what are the actual traders betting on right now? What do the futures markets say?
Well, the futures market is definitely leaning towards more easing, but maybe not quite as aggressive as that outlier. Right now, traders are pricing in about 125 basis points of additional cuts by the end of 2026.
Okay, so the market believes the easing cycle is real and has further to run.
Yes, but there's still a lot of uncertainty baked in about the pace and whether these cuts are, a smart move or a desperate scramble.
All right, let's bring this back to the listener. For you watching this unfold, what does it mean practically? If things go well, if this easing cycle works as intended, where could the opportunities be?
Well, the obvious places are where cheaper money helps the most. If easing continues, you could see more upside in equities, especially those growth and momentum stocks we mentioned. Their valuations get a boost.
And what about sectors beaten down by high rates?
Exactly. Think about credit-sensitive areas. Housing, autos. Lower mortgage rates could finally unfreeze the housing market. That would be huge. And companies could refinance expensive debt more easily.
Any other potential upsides?
Maybe a softer dollar. If the U.S. cuts rates faster than other major central banks, the dollar could weaken. That helps U.S. exporters, makes their goods cheaper overseas, and it boosts earnings for multinational companies bringing foreign profits back home.
Okay, that's the optimistic case. But we have to talk about the risks. This feels like a high-wire act. What are the big dangers here that people need to watch out for?
There are definitely significant risks. Number one is inflation expectations. This is crucial.
How so?
By cutting rates when inflation is still above their target, the Fed risks sending a signal, even accidentally, that they're giving up the inflation fight too soon. If people and businesses start thinking, okay, maybe 3% or 4% inflation is the new normal, that belief can become self-fulfilling. It gets embedded, and it's really hard to stamp out later.
The bond market already seems worried about that with the 10-year yield rising.
Precisely. That's the market flashing a warning light. Risk number 2 is credibility.
Stemming from that internal division we talked about.
Exactly. When policymakers are publicly divided, it makes the Fed look less decisive, maybe even influenced by politics. And if markets lose faith in the Fed's unity and independence, you get more volatility. Traders start overreacting to every little piece of news.
Okay, and the third big risk. This sounds like the worst-case scenario.
It is. It's the recession scenario. Remember, monetary policy works with a lag. It takes time for rate cuts to affect the real economy.
So they could be cutting now, but the worst of the downturn is still coming.
That's the fear. If that job slowdown really picks up speed, if those million revised away jobs turn into millions of actual job losses next year, the Fed could find itself cutting rates aggressively right into a recession.
While still battling that sticky inflation.
Exactly. That's the full-blown stagflation-late nightmare. Slow growth, maybe even contraction, high unemployment, and persistent inflation. It's the scenario policymakers dread because the tools don't work well. So look, to wrap up the stakes here, the Fed has made a really big bet. They're betting they can prop up the job market without letting inflation get out of control again. History suggests that's an incredibly difficult balancing act.
So the key question isn't really if they'll cut more, but what the consequences will be. Will we look back in a year and say, this was a smart, timely rescue?
Or will we see it as the moment they lost the balance, the moment they prioritized jobs so much they let inflation expectations drift dangerously higher? That's the core uncertainty. Expect more volatility.
See you all in the next ProTicker Deep Dive.